All right, let's break down Gogoro's second quarter 2025 earnings call. So, management is telling a story of strategic discipline in what is, let's be honest, a pretty tough market. But did the market actually buy it? Let's get into the numbers.
So here's the game plan. We'll start with the market's reaction and the headline results. Then, we're going to dive into this core conflict that's happening inside their business model, look at their path to actually making money, and finally, land on our rating and even a potential trade idea. Let's just dive right in.
So how did the market react? With a pretty modest 3.35% bump on low volume. I mean, it's not exactly a standing ovation, right? It's more like a quiet nod. It signals this cautious but constructive feeling. Basically, the market saying, all right, we're watching. Now show us the proof.
And you know what? That caution makes a ton of sense when you dig into the numbers. This was a really mixed bag of a quarter. You've got some clear signs of pressure, but also some, surprising strength under the surface.
Okay, so revenue, $65.8 million. Ouch. That's down almost 19% year over year. And they posted a GAAP loss of 9 cents a share. But, and this is where it gets interesting, their adjusted EBITDA was actually up 4% to $12.5 million. And their subscriber base grew a healthy 7% to 648,000. So you got to ask, how in the world does your bottom line get better when your top line is shrinking like that?
Well, the answer really comes down to what we're calling a tale of two Gogoros. You have to think of Gogoro as two totally different companies under one roof right now. And man, are they heading in completely opposite directions. Yeah, this slide, it just lays it all out, plain and simple. Look at this. On one side, hardware sales. Selling the actual scooters just fell off a cliff, down almost 40%. That is a huge hit, driven by a weak market in Taiwan and a product launch that got delayed. But then you look at the other side of the business, that high-margin recurring revenue from their battery swapping service, it grew by a solid 8.5%. This, right here, is the engine. This is what the whole future of the company is built on.
Okay, this slide is super important because it really shows you what's going on behind the curtain. At first glance, you see that official IFRS gross margin, 0.3%, and you think, yikes, that's terrible. But then you peel back a layer. You look at the non-IFRS margin. Basically, you pull out those one-time costs like their voluntary battery upgrade program. And what do you see? You see a healthy 17% gross margin. And that's up 3.5% from last year. It shows the core business is actually getting way more profitable.
And hey, don't just take it from me. The CFO, Bruce Aiken, he laid it out really clearly on the call. He's basically saying, hey everyone, that core energy business, the subscription engine, it's pretty much breaking even right now. That's the message management is desperately trying to get investors to hear. The pain from these battery upgrades, it's temporary. It's strategic.
So what this all tells me is that they're not just hunkering down and hoping the storm passes. They have a plan. Let's take a look at that road to profitability, because it's absolutely paved with some serious financial discipline.
$11 million. Remember that question we asked, how do you grow your adjusted EBITDA when revenue's falling? This is how. Pure cost control. Management has managed to slash $11 million in operating expenses just in the first half of this year. This isn't just talk. These are real savings hitting the bottom line.
But they're not just playing defense by cutting costs. They're on offense too, trying to adapt. Look, things are tough. The Taiwan market is weak, down 11%. And yeah, they had to delay that new, more affordable Easy scooter. But look at how they're responding. They're rolling out new, super flexible pay-as-you-go plans, and they've got another new vehicle dropping in Q3. They're trying to get people back in the showrooms. And for anyone worried about the long term, they've laid out a very clear roadmap. This is their promise to investors. By 2026, the energy business will be breaking even for the full year. By 2027, the whole company turns profitable. And by 2028, even the tough hardware business is supposed to be in the black. That's the plan they're sticking to.
All right, so let's put it all together. Where does this leave us? Let's talk about our rating and what we need to watch for on the next call.
I've got my eye on four things, four key catalysts. First, that new Q3 vehicle launch. Is it a hit or a miss? Second, what's happening with that joint venture in Vietnam with Castrol? We need to see some real progress there. Third, they need to get that battery upgrade program finished. Once that's done, their official margins should get a nice boost. And last, but definitely not least, is the big one, the elephant in the room, that October 27th deadline to get back in compliance with Nasdaq. If they don't get that stock price up, they might have to do a reverse stock split. And let me tell you, investors hate that.
So after weighing all of that, we're landing on a market perform rating. You've got these awesome positives, right?
the incredible discipline on costs, that beautiful growing recurring revenue. But that's all getting weighed down by the weak scooter sales and this huge cloud hanging over the stock, which is the threat of getting delisted. Right now, it's the definition of a show-me story. Management has to prove they can execute.
Okay, so with that rating in mind, let's have a little fun and talk about a potential trade. And you know the drill, this is just for educational purposes.
So what's the play here? How could you actually trade this cautiously optimistic kind of setup?
All right, here's one idea. The thesis is pretty simple. The market is just too focused on the ugly hardware numbers and isn't giving them enough credit for that pivot to recurring revenue. So the play could be to use long-dated call options. That lets you capture a ton of the upside if they execute well in the second half of the year and the stock gets a re-rating, all with a defined amount of risk. But, and this is a big but, you hedge that bet by keeping the position size small. You have to respect the risk here. They could fail to execute or they could get delisted. It's what you'd call an asymmetric bet on management pulling it off. And it really all boils down to one single question. Can that powerful subscription engine finally start to pull more weight than the struggling hardware business is dragging it down?
So as you think about that, please remember, everything we talked about here is for informational purposes. This is not financial advice. Always do your own research and talk to a professional before making any investment decisions.